Well, in this special podcast, we're joined by Andrew Canter, the Chief Investment Officer of Futuregrowth in Cape Town. Andrew, thanks for joining us on the line today. It's been quite a watershed week. Not too many people have missed what went on in the share market because of the visibility of share prices, but it's been just as bad in the bond market.
Indeed, I mean the bonds had a very quick and nasty bear market. I mean we're talking 150 basis points straight up.
Just explain what that means, 150 basis points.
Well, so take for example your R186, your 10-year bond went from a yield of about 8.60 up to above 10. I think it even peaked at about 10.4%. So that would have been a capital loss in the bond market. I'm going to estimate now probably 12%. For the all bond index in the 3-day space.
And bonds, why do people invest in bonds? Or just what kind of investors go into them?
Well, so your core holders of South African bonds are pension funds, domestic pension funds, where you'll always have an allocation to bonds as part of your risk allocation strategy. Obviously, bonds generally act in reverse manner to equities. When equities go up, bonds don't necessarily rally. When equities go down, bonds usually do well. The other big holder of South African bonds will be foreign investors who, again, fit it into pension funds or long-term insurance funds as part of their overall strategy of holding some emerging market debt.
Would you be able to give us an understanding of how much of the South African government bonds are held by foreigners?
Off the cuff, no. I don't have the number, but it's substantial. I'm going to guess it's probably 300 billion rand or something like that.
All right, so about a third of the total.
Yeah.
Why was it important that we paid attention to this spike in the bond rates?
Well, okay, so I mean, when you lend money to somebody, anybody, the government or a corporate, for 10, 15, 20 years, you're really making a faith statement in their future, aren't you? You're saying, I believe they're going to be able to service this debt for 20 years, and at the end of 20 years, pay me back my capital. Now, what happened with the politics last week certainly rattled the faith that people have in the South African government as a long-term borrower. Will they pay me back? Will they pay me back in rands that haven't been inflated out of existence? When the Minister of Finance, the proposed Minister of Finance, is somebody who's a complete unknown and doesn't come from a financial or the Treasury background, it doesn't really make you want to lend money to government for 20 years, so you quickly sell bonds.
Was there a chance that had the decision not been adjusted in the way that it has with Pravin Gordhan going in, that when those bonds came up for renewal, in other words, rolling over, that foreign investors would say, no, thank you?
Well, so there's a couple of moving parts. I mean, South Africa is already on the cusp of being downgraded below investment grade by the international ratings agencies, and we're on notice, actually. This change, and if it really was what it looked like, a signal of a lack of fiscal responsibility, a willingness to play politics with the purse, that was going to be a serious problem. We would have been downgraded. We're already on the cusp. And if we're downgraded, foreigners won't buy South African bonds. What it means net is that yields are going to be higher. The cost of financing, whether you're buying a car or a house or financing a business or the government is financing itself, the cost of finance was going to keep on rising. In the absence of a reversal of this policy last night, you would have seen bond yields open up higher again this morning. From 8.60 last week to 10.20, 10.40 close of Friday, it would have been up to 11% today. Nobody was going to get in the way of this freight train because there was no reason to get in the way of it. The outlook was really deteriorating very quickly.
And what did happen this morning?
So the market stabilized. The announcement of Pravin Gordhan being reappointed was taken as very positive in and of itself. So the bonds actually rallied back down something like 90 basis points of recovery. And as the rand also came off the 16 to the dollar level back towards the 15 to the dollar level. I'm sorry, I'm speaking in generalities because it's a fast-moving market. And so the market has recovered somewhat. But let us be clear, it has not gone back to where it was a week ago. We still in a space of uncertainty where confidence has been if not shattered, certainly badly bruised. There's going to have to be some trust rebuilt by this government in people who are holding its currency, the rand, and people holding its debt. And
how do they rebuild that trust?
The way they've done it over the past 20 years, frankly, by even if you can't always be fiscally prudent because, the economic cycle goes against you, the growth is low, so you have to have more transfer payments to individuals to let them eat. You show fiscal prudency while you do that rather than just playing politics with the fiscus. and you just do that year after year and time after time. That to me, if there's one lesson, well, there's several lessons out of this, but without talking about the political lessons, if there's one economic lesson, and my biggest fear now is that the psychology of inflation, the fear of fiscal imprudence or government imprudence, is going to lead people to expect more inflation. Therefore, we will have more inflation. Therefore, we will have higher interest rates. I mean, the remarkable thing about the last sort of 2 years, as the rand was going down and down and down in a fairly inexorable way, is we didn't get much inflation pass through. I mean, inflation is supposed to peak about 6% in the first quarter next year, and then recover. That's not very much pass through at all, considering the rand's decline. Now, with this most dramatic event and the breaking of confidence and the psychology of inflation perhaps having been introduced, the trust being broken in the prudence of government, you could have systemically higher inflation. You could have inflation back up to the high sixes or 7% or more, and therefore a requirement for higher interest rates in the economy. That's a big cost to this economy.
Andrew, you explained that we haven't got back to where we were before the firing of Nene. Is there any way of quantifying what this means? How much money the decision might have cost the country in the bond markets?
Oh, there probably is, but I mean, how do you measure confidence? How do you price confidence? And I don't think you can practically do so. Let us say if you were thinking of investing in South Africa, if you're sitting in Europe and thinking of doing something here, you're probably thinking twice about it. Let us say if you're a domestic manufacturer, you're about to build a new plant, you're going to think twice about it. If you're thinking of lending money to a corporate, you're going to think twice about it and charge a higher rate. If you're thinking of buying shares, you're going to think twice about it and maybe demand a higher return on equity or lower PE ratio. So there are tangible costs. It's hard to aggregate them. And the change in psychology of inflation alone, because of the costs in higher interest rates across the economy, is an enormous cost. I mean, it's in the high billions, but I couldn't hazard a guess.
So you did say that there were lessons to be learned from this whole episode.
Well, okay. So the first lesson is that confidence that you build up over a decade can be lost in a couple of days, and I think we can see that in spades. Another lesson which we learn is that in a crisis, liquidity is your best friend. you want to, we learned this in 2008. Now we learned it again now that when everybody's running for the hills, if you've got cash to be able to deploy and do something, you can often pick up some pretty good deals if you've got the testicular fortitude to do so. And the third lesson, I think we all learned this lesson, me as much as anybody else, is that actually, well, it turns out democracy seems to work. And I thought, even the most cynical or optimistic amongst us wouldn't have anticipated a reversal of that appointment over the weekend, but thankfully it did happen, and it does seem to be a sign that South Africa is a democratic country with the populace. A cocktail party conversation amongst non-financial people this weekend was about the Minister of Finance. Well, that's extraordinary in itself, and the fact that it got airtime with governments at the very senior levels who realized the mistake being made on a long-term basis, and they reversed it. I mean, it's exciting. It's exciting to see democracy in practice.
And for a young democracy like this to learn those lessons early on is not a bad thing. But Wednesday we are expecting that there are going to be marches. Probably the Zuma must fall hashtag shown on global television. Is this something that would spook the international investors in the bond market?
Hard to say. Probably not. I'm not a political analyst and don't delve in those waters much, but if you listen to the international press or read the articles, Mr. Zuma's reputation isn't stellar. There's not a lot of respect in that tone of voice, and I think it would not be perceived as a bad thing for South Africa if the populace is marching. And that's not making a comment about what should happen with his administration. That's just an observation.
Andrew Canter is the Chief Investment Officer at